Marquis. We got Mark on the line. What do you want to ask
Mark,
him?
So when you're syndicating, what metrics are you looking in regards to your hold patterns?
We'll underwrite for 5-6 years, depending on the deal. Rarely it'll be 7, but let's say 5 or 6 years. And some investors will say, well, I want to know exactly what your exit strategy is in year 5. Well, you know what? I would never invest in a deal if someone told me I'm selling in year 5. Why would I do that? The market could be horrible at that time. So you need multiple exit strategies. We've had properties where we said, hey, it's a 5-year pro forma, and we sold in 14 months. It made sense to do it.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Far Oaks Capital, and I'm very excited for today's show. It's one of our Ask the Expert episodes. We've got 2 amazing people on the line with us. We've got a man with a ton of experience in this business, Mark Kenney, and a motivated, aspiring investor, Marquis Campbell. So first, Mark started investing in real estate when he was a senior in college over 25 years ago. I'm sure that's a typo. It's probably 15 years ago, right, Mark?
Unfortunately, it's more than 25 now. I don't want to update it because people can tell how old I am.
Yeah, I know, right? But moving along, he's purchased over 10,000 units and currently owns 8,700 in 9 different states. He's purchased all property types from 46% occupied to 98% occupied and has added value through management CapEx ranging from 5K a door to 20K a door. Those 20K a door ones are fun. And prior to becoming a full-time real estate investor, he was a CPA and had his own IT company where he provided consulting services to Fortune 500 companies. So, Mark, welcome to the show.
Thanks for having me, Brian. I really appreciate it.
Yeah, this is a lot of fun. I've been following you for a while, and we actually had a couple of people on the podcast 2 weeks ago who were part of your Think Multifamily. So actually, let's do this. Why don't you tell, before we kick into everything, why don't you tell everybody what Think Multifamily is, and we'll go from there.
Yeah, great. So we focus 100% on multifamily. So we obviously purchase multifamily properties, but we also host events, live events, typically in the Dallas area where I live. And then it could be kind of general, different parts of multifamily. We also do a deal analysis workshop, which is kind of hands-on, bring your computer, work through deals together for a few days. And so we have a coaching program as well. So people that are trying to get involved in syndication, maybe not sure where to start or looking for a community, people that can come in and help them. We provide one-on-one coaching in that respect. And I do all the one-on-one coaching in our group. We don't have sub-coaches or anything like that as well.
Nice. Yeah, I heard a lot of great things about it. You know, like I said, we brought on, Mike Van Groningen and Tyler Caglia, and they both spoke very highly of you. So I was super excited when you said you'd be on the podcast. But that said, why don't you give us a little bit about your background and history and tell us what kind of led you up into apartment investing?
Yeah, so I grew up in Michigan. I'm one of 7 kids. I have an identical twin brother, both probably pretty analytical, both CPAs, both did IT. But pretty young age, we were like, man, this kind of stinks, buying your own shoes and clothes and bikes when you're like 10 years old, and seeing my dad work literally, 100 plus hours a week because he was a firefighter, plus worked full time, another job in addition to that. So he was gone a lot. And when he was home, he's working on cars breaking down and TVs and all that. So my brother and I look at each other going, man, this is not fun. We don't want to be in that situation. So really didn't know what we're going to do, but we were seniors in college and we're like, we like real estate. Why don't we go look at some real estate? So we started looking together. We started buying small properties, 2 to 4 units together. Didn't know what syndication, raising capital from other people even was at that time. Started buying in our hometown in Michigan and continued to work corporate jobs. And did pretty well. I mean, from a lot of respects, financially, if you want to say. I started IT business, but my biggest thing was I was working, minimum probably 90 plus hours a week. Yeah, I would sleep about 3 hours a night, not like once in a while, but that was my routine. I really didn't take care of myself as far as eating, and fortunately, I was spent some time with my kids, which was good because they were little, but I neglected my wife, Tamil, and really didn't have time. People all over the world on projects and my phone going off like 24 hours a day, literally. Yeah. And so my wife is like, Tamil's like, you need to do something different. This is not working out. Yeah. And I'm like, well, I'm thinking like, well, kind of is what it is. But I'm like, we both like real estate because Tamil and I started buying real estate too, got married pretty young. Bought together. She said, well, why don't we start buying larger properties? And I said, well, you're gonna have to help me. So that was where we ended up getting involved in the larger kind of 100+ unit properties and looking at syndicating. We invested passively first with a friend of ours in a multifamily investment through some retirement funds, and did that a few times, and then decided to try to do it on our own. And it took us about a year to find our first deal. I mean, I was, everyone has an excuse. I really was super, super busy. Plus, we were distracted looking at other opportunities outside of real estate as well, like franchises. And my whole thing was trying to find an out from my grind, if you want to say. It wasn't so much financially. In fact, I thought I would probably make less money doing real estate than I was in my IT business, but that was okay with me because I needed to get my time back and kind of get my relationships back on track.
Yeah, that's absolutely crucial. I mean, if you were only sleeping 3 hours a day and then, all of a sudden you have to do more, hey, you work on relationship, where's the time come from? So yeah, I think I would take a pay cut to have better quality of life, but I think it's a good trade. Very, very good trade there.
For sure.
Now, you said when you started out, you had no idea what a syndication was. Where along the line did you figure out, hey, we can syndicate, we can use other people's money, we can bring in investors?
Yeah, my wife, she was a nurse at the time, and she worked with somebody, and her husband was just getting into syndication, and we were over their house, and he was talking to me about, some real estate he was doing. I think his first deal was 116 doors.
Okay.
And I'm like, sounds interesting. And, it made a lot of sense. I was pretty quick to pick up the analysis piece just because my background and things like that.
Yep.
Everything looked good. And I had already been buying smaller multifamilies. So I said, I'll put some money into his deal. Did that. After a few months, I'm like, kind of learned more and more. And then I'm kind of like, well, I think we could probably syndicate ourselves. Technical knowledge. My thing that really concerned and really kind of petrified me was raising capital.
Yeah.
That was the biggest thing that really scared me to syndicate. All the other aspects of it, building relationships, visiting properties, analyzing it, getting loans, all that stuff I really wasn't that concerned about, but it was the capital side that concerned me.
Yeah. And I'll be honest, I'm a very technical guy. I got 2 degrees in math, so
I remember that.
Yeah. So it's just one of those where I had the same thing coming in. It's just like, okay, I can analyze, I can call brokers. I can ask them questions. I can get all the information I need. I can work in that relationship. But I was the same way. Capital raising scared me. Got over the hump though, but that was my biggest fear going in. What did you do to get over it? I mean, how did you guys get past that?
Well, the first deal we did, for all practical purposes, was a smaller raise. This was a number of years ago, but about $1 million raise. And fortunately, I had a partner at the time that could cover a bit of it if we didn't raise it. So, I probably had it easier than some other people. He wasn't going to cover it all, maybe cover half of it. And I've been doing IT for a long time, and we were going to events and meeting people. And so we felt fairly comfortable we could raise it. We didn't really know, but just kind of putting it out there. And then I talked to a ton of people about the deal, and they knew I was already doing some real estate, but not to that level. So my prior experience, even though it was small scale, helped some, not a lot, but helped some. So it was really just getting out there, taking action. Didn't know where it was going to go. Let's see. But like I said, having someone that could cover, let's say, maybe half of that at the time gave me more comfort level.
Yeah, you had a little bit of a safety net there. It's we need to raise $1 million, but really we need to raise 500K, and that's right. That's much more bite size. I don't know. Somehow when I was starting out, and let me know if it's the same with you, but once you put that $1 million price tag on the back, for some reason, difference between 999,000 and 1 million, they're big mental jump for me.
It is, for sure. Like you mentioned, you go through it, you learn a lot. I think a lot of it comes down to people just, trusting you. I'd done business with a lot of people, and, had a good reputation as far as doing what I say I was going to do and things like that. Plus I had invested passively in a few deals before I started syndicating, which gave me a little bit of credibility too, because I was, for instance, a partner in some deals that way. So I had a few of those things going for me, I guess, as well.
All right. Nice. Well, good. So let's talk about some of those deals. So pick a deal or tell us kind of your overall criteria. Let us know the type of stuff that you guys do.
So we bought pretty much everything, from A to C. So if you're not familiar with that, just think of new buildings versus older buildings. And my whole thing is we still buy all different types, because we do have a group and people in the group look at a lot of different deals. And I kind of like more the B-ish type assets, frankly. The issue with some of the older buildings are, usually plumbing for one. It can be, right, depending on what they've done for upgrades and things like that. Or it could have like a chiller system, which is one unit to heat and cool the entire property, and a couple stories around those situations too. But, as far as deal wise, you mentioned, we bought properties 46% occupied to 98%. We actually did one recently, 0% occupied, which is actually better than 46 because you don't have to contend with people living there, right?
You just go straight to your CapEx. And done. Yeah. Renovate and start filling. So
that's right. And you kind of section it off and things like that. But I think starting out, I don't think it's a great idea unless you have a lot of experience in construction. I don't think it's a great idea to buy a property like that, your first property. I think it's riskier, and good chance going to cost you more money, take more time, things like that. And but that 46% occupied, within 15 months, we did a refi, which is very fast, and we pulled out like 87% of the capital, which is a lot.
Wow.
But it was, it's first kind of deal we did like that, so it was riskier. So you have to kind of define your criteria and see whether you're willing to take those risks or not as an investor and or as a syndicator. But I would, personally, I think, I wouldn't want to do all deals like that because they are riskier. And like I said, that one just happened to be where it was about $14,000 a door CapEx. Pretty much everything worked out, even better than anticipated, which is not the case. Lots of times things happen, but it did on that property. So we started buying other properties like that as well that were kind of, in distress and things like that. So I like the distress ones for the big potential payday, but they're also bigger headaches.
Yeah. And that risk versus reward and work versus reward. And I think you're absolutely right. Our third property, we purchased at 55% occupancy. And, it's been a long road so far, and we're getting there. And you're right. It's the smallest property we have, but it's also the biggest headache we've had, completely hands down. Anyway, we're at a point right now where we're almost done with all the renovations. The occupancy's coming up, so we're about ready to have the good news story and the refinance coming up here soon too. So knock on wood so that I don't jinx myself. But
it's risk versus reward, which is totally true from a financial standpoint. And then it's the stress related to some of those deals, right? Typically they're in, a little bit rougher markets, not always, but sometimes. So you're contending with, some other things like, the crime and those aspects of it as well, which can cause some stress for you as a operator.
Yeah, our biggest stress has actually been the housing authority. It's a project-based housing, which I would also not recommend for, first or second deal, but we saved it for our third deal, and I would probably not recommend it for your third deal now that we've done it. But I think the biggest stressor on that one has been working with the housing authority, just because government agency, they work at their own pace, and they're not in a hurry for anything. That said, let's shift gears. One of my favorite questions to ask anybody is about your why. What is your big burning why?
I mean, my why originally was kind of get time back with my wife and probably get my life more in balance, as far as it didn't look like I was unhealthy, but I had to be unhealthy. I really wasn't doing anything other than work and stress, and then not eating much food either on a daily basis. So getting my life back to where, marriage is great now. It's been great for, for 5 years, but I've been married for 26 years. So, we had some, some harder times where I was working those long hours, but that was the biggest thing initially. And then when we started thinking multifamily, there were two aspects to it. One, I'm more a transactional guy, wanting to continue transactions. I felt like there were a lot of people trying to teach or teaching. You're either lazy or don't care, or whatever it might be, not really teaching all aspects of the business, which really frustrated me. And I'm like, man, I wish I would have known all these things when I did my first deal. And then the other aspect of it was community, which was less of of an idea for me, frankly, because I was just transactional guy. My wife to me was like, hey, we're gonna build this community and all that. I'm like, okay, whatever, I'm just doing transactions. But fortunately, all our relationships now come from the group. We go out to dinner pretty much every Friday night with some people in the group. We just got back from Clearwater, Florida, with, I think we had like over 70 people with kids and stuff in the group there. So it's all the other aspects of it. We had a mentor once before that said, oh, you don't have to like me. I'm like, man, it sure be nice if I did. Be a lot better, So We wanted to develop the whole thing. My whole thing was I want the most educated people doing deals, do what we say we're going to do. We're good buyers, we're good sellers. And then the whole community aspect of it, people coming together, helping each other, not competing against each other, but then also, kind of doing life together where our kids grow up together. We hang out together on vacation. We have some people from the West Coast that come in, 3-4 times a year, spend time with us, and just stuff like that makes it that much better, because I didn't have that before.
And that's something, like I said, I've talked to a handful of people that are inside your community, and that's one of the things that they all point to as being the biggest benefit. It's hey, we're all friends, we're all hanging out together, going places together. Right. So I think whatever you guys are doing, it's working. So I sat back and just kind of reflecting on where I've been and how far I've come, and I've realized that it's been the people that I've met that have pushed me the furthest. Hasn't been, transactions or anything else. It's always been people. Right. So there's something about that community that really gives people.
Yeah, that's great.
Anyway, last question before we bring Marquis on. What's next for you?
My whole goal has been there are probably people similar situation to me, maybe not as bad, some cases maybe worse. And we want to provide an opportunity for people, if they want to buy multifamily, provide the opportunity to coach, mentor, whatever, partner up on deals, and really help people go as fast as they can, and then retire as fast as they can. Retire is relative. Are people sitting on the beach? No, they're usually typically doing things, but we've had a number of people that have been able to quit their W-2 jobs. It's either probably they quit or get fired because they're working, they're doing both at once, right? Oh, I'm gonna try to do multifamily on the side, right? So we had a number of people that have been able to, we get a lot of people that reach out to us in the group, either call or text or email, just about how they feel their life has changed like drastically. And I always say, well, they thank us and all that. I'm like, that, yeah, great. We started the company, we provide community and training and coaching, but at the end of the day, if they didn't take action, nothing would happen. So they have to, most people don't want to say, oh, well, I did it because I, took action, things like that. But there are people that don't take any action, just like fitness, right? If you hire a coach and you don't ever go to the gym, good luck. Yeah. That's not his fault. It's your fault, right? So same thing for us.
Yeah, I agree. A lot of things there that resonate. I mean, just with my job, technically I'm still active duty military, so I'm in my transition time, but when you said quit or be fired, I think if I were in any other job, if I wasn't like a government employee in the military and where I'm at, I'd almost have to commit a felony to get fired or kicked out. But any other job, I probably would have been fired, because that's exactly what happened. It's, I'm spending so much time and effort on multifamily that, my day job kind of fell by the wayside. And I see that happening a lot. And for a lot of people, it's like, all right, I'm done with this, moving on to that. But
that's one of the advantages having people you partner up with too, is maybe you have a busy season, right? And you have other times you're slower. You can, hey, I'm busy right now, whoever the other person is in your partnership, can you take care of this? So that's one of the advantages too. Yeah, you're going to make less because you have more people involved, reality, but you're typically doing less as well, and focusing hopefully on the areas that you're good at, you like to do, versus working in all the areas, and some of them guaranteed to some areas you're not going to like as a syndicator.
Yeah. And that there is something to say about that. Our company, there's 5 of us, started out with 4, hence 4 Oaks Capital, but we all have our very narrow lanes that we work in, and we're all in lanes that we're good at and enjoy. Great. So yeah, you're split the profits 5 ways, but I wouldn't have it any other way. But I know some people like different models, but I like what we got going. Yeah. Well, that said, let's shift gears again, and let's bring Marquis on. Marquis is a native of New York, born in the city, raised in Albany. Now you're in Jersey, working in New York City, right?
Sure.
All right.
In Jersey now, and it's hot today, and I'm happy to be home to get on this podcast. And thank you for the time, Brian. I appreciate it.
Yeah. As far as your bio, you've been an investment sales broker at Cushman, which is a big, multifamily, or not just multifamily, but commercial real estate brokerage. Tell you what, let's just get your bio from you. Tell us about yourself. And for anybody listening, I'll throw his bio down in the show notes. But Marquis, go ahead and tell us about yourself and what brings you here.
So I'm pretty much from Albany, New York. I was born in New York City. Was a basketball guy. Had a college scholarship to play at Concordia College, Division II school.
Nice.
Didn't have the hops like LeBron James to get to NBA, so I decided to pivot to knowing what I know best, and I was using my degree. So I started to work in sales, and to be ironic, the first job out of college was car sales, and that's when I learned the psychology of selling. Using my ability to build rapport with people, and just learning how money works in different type of ways, and learning commission as well, being an entrepreneurial spirit. And one day, I just started noticing that my time, kind of like you, Mark, I was young at the time, so at 21, I need time, I guess. But I noticed my Saturdays were going away, and then my mother fell ill with breast cancer, so I had to move upstate back to Albany, and just help out around with the family, be there as a support system, and kind of just pivot. When I was in Albany, I started to see a lot of investment commercials and with real estate, and I always was kind of like worry about those things, but obviously stuff was happening around the capital region as well. I started to see a lot of new developments go up, money being parked to different areas. So one day I decided to, go and visit the, one of these investment communities and at a hotel and just hear what they had to offer. And ever since then, my mind has been focused on real estate and creating generational wealth for my family, especially since, I'm a firstborn American. My mother is from Jamaica, and there's four of us. And we've rented most of our lives. And a lot of people in our communities, in many communities, don't understand the concept of that they are paying rent to another individual who's a landlord and operator. That spurred my interest even more, and I kind of wanted to understand real estate from a micro and macro point of view. And I decided the best way to do that was getting my hands dirty and learning how to be a broker. And I've been blessed with the opportunity to work at Cushman and Wakefield, doing brokerage and then middle markets division and investment sales. I operate and selling anything, any building from northern Manhattan all the way to in the Bronx. And anywhere in the tri-state area, specifically, I'm able to leverage those services. And my experience thus far with Cushman and Wakefield has been great, but it's even just honing in the fact that my end goal is to, invest like how you guys are doing in the syndicate. So, that's a little bit about me, just humble beginnings, and I'm excited to be on the show and just to dig in and learn a little more.
Yeah, so one thing I absolutely love is, you wanted to learn more, so you throw your towel in with Cushion Wake, and that's something that I read about a long time ago. Robert Kiyosaki and Rich Dad Poor Dad, which is probably mentioned on every single episode, talks about getting jobs to learn, and part of me wishes that if I could go back 20 or 30 years may be too long, 25 years, that I would have gotten jobs to learn about things like you did. But I love it, humble beginnings, and let's see if we can step it up a notch. But talk to me later. I got a buddy from Jamaica. I'll introduce you guys later and see if you guys can hit it off. But he's a good friend of mine. Yeah. So you talked a little bit about, your reason, but if you can boil it down to one or two sentences, what's your big burning why?
Yeah. So I would say two words: self-sufficiency and generational wealth. I've seen, through my family, I've seen, just the importance of having stuff to pass down to generations behind, because you're giving them a leg up on the whole competition of life. And in general, I feel like when being an investor, you're also doing the community service as well by beautifying communities and developing communities, or as well as creating housing when needed. So it's selfish and selfless at the same time for me. And that's my passion. I know I'll definitely attain it. So.
Yeah, I saw somebody throw on LinkedIn last week the phrase "grow to give." So there's one thing. It's hard to be a philanthropist. It's hard to give back if you're broke yourself. It's hard to help somebody up if you're at the same level on the ground. You've got to be able to grow to give back, and I don't think that's selfish at all. I think that's just part of what you have to do. So that said, Marquis, we got Mark on the line. What do you want to ask
Mark,
him?
So appreciate the time. I have a lot of questions. One specifically, you were mentioning, how at first you were nervous, about talking about capital, and asking for capital, as well as Brian. When I'm on as a broker, I'm on the phone all the times with just a lot of people, and a lot of people of influence as well. And it's easy to ask for the sale for a building. Hey, I have a machine behind me. I'll be able to market your building the proper way. But that hump of asking for the capital, when did you just like say this is the method I'm going to use to ask for the capital, and when did you implement it? Like what methodology?
Yeah, at first you try to raise capital, you're going to have a lot of questions asked of you, and you're like, okay, I wish I knew the answer to this, and then you just get to where you can almost predict every question someone's going to ask, and within reason, right? For me, my biggest thing was, rather than trying, if you want to say, ask for money, initially I probably didn't do a very good job understanding what the investors' goals were. You have money to raise, you want money, right? And then pretty early on, I started asking people what their goals were, and you can ask investors too that we deal with it. There are a number of investors I've talked out of deals before where they were probably ready to invest, or I've suggested they put a lower amount in. So first and foremost, I think, is understanding what their situation is financially, and then also what their criteria is, and not trying to just put them in the deal that you have active. I can tell you that goes a long ways, because people are like, man, I can't, thank you for doing that, right? Because I might be trying to get into they want cash flow, but the deal is 50% occupied. Not going to cash flow for 18 months or 2 years and things like that. So trying to be a little bit more of on the financial advisor perspective, not financial advising them, but understanding their goals. And then the other one I got really good at, which you're probably better at now because you do sales, is like, it's okay if they say no. All right. It's not a reflection necessarily of you. It could be a reflection of the deal. The deal doesn't fit what their criteria is. That's totally fine.
Right.
So I guess it was more not really asking for money, understanding their criteria, understanding what deals they like and don't like, and then trying to guide them that way. And then just presenting the deal to them. If they say no, it's a no. But we've had people that literally have gone 3-4 years never investing in a deal, and then they invest. So don't get to the point. Be patient. I've had people send me tons and tons of questions before. Frankly, it takes time to do that. And some people might say that's pretty annoying. Someone sends you 40 questions, which, it is in some respects, right? But just being patient, working with them, understanding it's their life savings, or a big chunk of it potentially. They're investing for, you mentioned legacy, right? For generational wealth. They're trying to maybe do the same thing. So just trying to steer them that way. And then I would say also is trying to get hooked up with somebody that has a track record. It's just going to make your life a lot easier for capital raising if you can rely on somebody else's track record. Just reality.
So I also one of the things that like intrigue me, working in the city, as well as seeing how multifamily in New York is pretty restrictive here. I mean, the rent laws are very restrictive. Stuff that's going for 5 caps, 6 caps. In other markets, you can buy stuff for a higher cap rate, incur risk, but you're going to get a little return without the restrictions of legislation. So when you're looking at these secondary markets, what do you look at in regards to because you're from Michigan and now you're in Dallas? I'm assuming something led you to Dallas, and that's a great reason.
work, and it's much different for sure. So Michigan's probably more along the lines of people that grow up in my hometown, for example. My 4 sisters live there. I have 2 brothers, but 4 sisters live in the town I grew up in. They're, within 2 miles of my mom. And so that's not uncommon. People grow up there. They don't really move. They don't really travel much, things like that. Versus a Dallas, for example, very transient. People move here from all over the world and then leave, and more people move here and things like that. So we buy a lot in secondary markets. We buy, some primary markets too. The thing I like about some of the secondary markets that we've invested in, one, the rental percentage is very, very high. Number of people that rent, because again, they grew up there, they live there, they never move. In some cases, property taxes are not increased as much in some of the smaller markets. There's not, which is great. And during COVID, we had some secondary markets where the judges were still evicting people, not paying your rent, you're out. It's not going to happen typically in Dallas. It's not going to happen in New York for sure, but it wasn't happening in Dallas or Atlanta or any of those markets we're in either. So I do like that about the kind of secondary markets. Some of the disadvantages, I would say, it can be harder to find management there. Just can. There's not as many management companies as an example, is a general statement. So that can be harder. There are other things like, finding labor sometimes can be harder. It just is. But as far as rent control, I would never buy in an area that had rent control, period. In fact, we have a guy in our group that he had bought a lot on his own. I think he had like 250 units, smaller properties, things like that on his own, not through syndication. And, whatever it was a year and a half ago when some things in New York changed with rent control, things like that, he called and said his property values went down 30% overnight.
Yeah, that's the HSTPA, 2019.
Yep. Yeah. So,
Yep.
Those type of things. So I would say people will also say, well, this, Georgia or wherever is, Florida or whatever it is landlord friendly. Not necessarily. We're in Georgia up and down from north, to Dalton all the way down almost to Florida. And the court system, right, the judge there will dictate on how they handle evictions and things like that, COVID or not. And, we own a couple properties in Savannah, which frankly wasn't landlord friendly even before COVID, even though people say Georgia is landlord friendly. So you have to be careful about that too. But the biggest thing is that trying to raise capital can be harder in some secondary markets, unless you have a story. We own like in Dalton, Georgia. Most people don't even know what it is unless you're from Atlanta area. It's phenomenal. We own Gainesville, Georgia. Most people never heard of that. It's phenomenal. So some of those smaller markets, you need a story to be able to convey. Once you have one good story there, it's much, much easier because you can say, look, this is basically a rinse and repeat, almost a duplicate of what we just bought. And then you can share that story. But your first time going in, I would make sure it's a lower raise, and not try to do a huge deal in a market like that. And then build the track record there in that market. And then you can start doing larger deals and things like that. But we like secondary markets and quite a bit.
Yeah, we like secondary markets too. I think, you do pay a premium for things like management and construction because, a lot of times you're taking crews that are traveling, if they've got to travel 60, 80 miles, they're going to give you an upcharge on mileage both ways, so just things you gotta build into your numbers and your model. But most of our properties are in South Carolina, and we were lucky enough to have judges that were also evicting during COVID. And we have our largest properties in Augusta. And I'll say the same, South Carolina is more landlord friendly than Georgia is, that's our take so far.
I agree.
The one property we have there. So
I
good place.
I also like just seeing the trajectory. I love to like be in a pulse of what's happening in real estate. I know a lot of people I've talked to specifically from New York, they moved to Texas and Florida. But more importantly, their investment strategies have changed to a lot of single family investment properties, and they build these single family properties and pretty much make these little communities and whatnot. Are you privy to that as well? Are you usually building up, or instead of just a single family here and whatnot?
We've only really done one development project. Nothing wrong with it. Not really specialty of ours. I know a lot of people that do exactly what you said. They're building, 100, 150 houses, self-contained, things like that. I don't think anything wrong with that. Not something we really do, but it's almost to me, as long as you're doing something, you're educated about what you're doing, whether you're, buying a single family house or buying, a 500 unit property, obviously big difference there, but at least you're doing something.
Right.
Versus the person, my dad talked about it, he's passed now, but, he talked about buying real estate since I was little. Never bought anything, ever. So I think there's, nothing wrong with that. I will tell you from doing small properties, 2 to 4 units, trying to self-manage and things like that, horrible for me. It almost ruined my whole take on real estate, it did, but I learned a lot by doing it. I actually probably would not do it again if I had a choice, because the learning wasn't that great. It was a pain. So, but those communities like that, I don't think there's anything wrong with it. I would just say no matter what you're doing as an investor or as a lead, you better make sure you're educated enough and or teamed up with somebody that's been through it before. I wouldn't go out and say I'm going to go build 100 houses without having somebody that's done it before. I just wouldn't do it.
And
I agree. Part of it is dependent on what area you're in. I'm in Idaho Falls, and a lot of predictions are that Idaho Falls is going to double in size in 10 years, and that's a big change. And there's developments going up all over the place, so here where we're at right now, it makes a lot more sense there's not a lot of existing apartments, it's 60,000 going to 200,000 is where they are right now. But it depends on where you are. Here, I think the money's at the new developments. And incidentally, I've invested passively in one of those, and I'll probably invest passively in more. But same thing, I'm not gonna bite that off myself. I'm not going to start raising money for the new developments because it's not something that I know how to do yet. But still it's great enough investment that I'm still dipping my toes in a different way.
We've invested in a lot of other ventures, including real estate outside of multifamily too. But again, to your point, Brian, it's like I'm hooked up with somebody that's been there, done that I know, like, and trust, and I'll invest passively with them, but I'm not trying to go out and doing all those things on my own.
Yeah, gotcha. Totally understand that. And so when you're syndicating, like, what metrics are you looking in regards to your hold patterns, your hold terms? Like, are you looking for a 5-year hold, 10-year hold? When we do pro formas, when I play around with them, we kind of, it's different in New York, obviously, but do you look at it a case by case basis, or are you looking to hit target metrics each time?
We'll underwrite for 5-6 years, depending on the deal. Rarely it'll be 7, but let's say 5 or 6 years. And some investors will say, well, I want to know exactly what your exit strategy is in year 5. Well, you know what? I would never invest in a deal if someone told me I'm selling in year 5. Why would I do that? The market could be horrible at that time. So you need multiple exit strategies. We've had properties where we said, hey, well, it's a 5-year pro forma, and we sold in 14 months. It made sense to do it. We have properties we said we're going to hold it 5 years, probably hold it 10 years because we put $20,000 a door of CapEx in it. Return the money through a refi. It's cash flowing, so why not hold it longer and things like that. So I think it's a good question, because actually someone in our group just asked, they want to do this long term and present it that way. I said personally, just based on investor pool that we have, I think you're better off showing 2 options or more, but 2 options. This will look like we sell in year 5. This will look like if we actually hold it longer. One guy in our group, a younger guy, probably your age, he's been syndicating for, a year and a half, 2 years, and able to raise capital and do a lot of things on his own, but he's trying to present 20-year hold. And I'm like, I'm 50 years old. So I don't want to present 20-year hold for people that are, my age. Now, they might say great, but most people aren't going to. So I think you need to understand your investor, but having a single exit and only one exit is not a good option for sure. But I wouldn't go less than typically 5 years unless you're just doing flips. And I wouldn't go more, maybe 10 years for me on the high side. I would never probably present anything past that.
We usually do 3 to 5 years, and a lot of it depends on the loan that we're able to get for each property. So a lot of the properties we're putting 10 to 20,000 a door in CapEx, which takes it out of permanent debt. We're doing bridge on a lot of our properties, which 3-year extendable to 5-year terms. So what we're telling our investors is, here's what it looks like at year 3, but depending on where the market is, if cap rates continue to compress, we'll probably sell at year 3 and make a boatload. But depending on where the market is at year 3, we could also, refinance and push it out longer, so.
Yeah, same with us. I have over 20 bridge loans. And I agree. I mean, you have a pretty big time frame, 5 years, and you have, let's say at the end of, 24 months, you're done with your CapEx and everything like that. It gives you essentially 3 years with the extensions, right, to really make a decision. So it gives you multiple exits versus saying this is what we're going to do in this year. And in worst cases, that there are funds and things out there that actually have that, and they're required to, legally required to dispose of assets within a certain period of time. And they get to year 5 and they're like, oh, I have to sell these assets. Well, what if it's a horrible time to sell? Just doesn't make sense to me. But I think less than 3 years, pretty short, especially in the big value add deals, can take you probably 2 years really to kind of get everything around and everything. It shouldn't, on paper, it's going to take you less than that, but it's probably going to take you 2 years. And then you said you get a big payday, return equity, tax-free, still own the property, or you do a sale.
Yeah. All right.
So one of the reasons why, I thought about that question even more so, just thinking about what's happening with, COVID and interest rates potentially One key indicator I look at on a daily basis is the 10-year treasury. It's been fluctuating up and down, but I believe in 2 years, just is totally opinionated. These rates are going to go high with the banks, and I think the lending is going to be a little bit shrunken in regards to being able to recoup money back. And I think that's going to open up opportunities for value add properties, and that's why I just want to be able to, when I get to that point, then I think there may be opportunity to buy properties at a lower premium in a couple of years, just because of the inflation. I don't
you'll
know.
see more loan assumptions too, and we see it now because of all the prepayment penalties people have with agency debt, right? So with Fannie
Right.
Freddie, they're like, oh my gosh, people like, oh, we put in perspective, we have an $8.6 million loan, we had $2.6 million prepayment penalty after 5.5 years.
Wow.
I mean, what are you going to do, right?
Yeah.
So if you sell it, most likely you're going to sell it on an assumption. I think as rates go higher, if they go higher and people are getting rates, people will assume those loans. In some cases, they assume it with a supplemental loan, get to 75%. If it's allowable, rates going a little higher isn't necessarily a bad thing for people selling. It's not necessarily a bad thing for people buying either, but you might have to do a loan assumption instead to make it really work.
Yeah. We've done 2 loan assumptions, and we've actually got higher than market rates right now on both. But we were able to negotiate purchase price down. So based on those, I mean, nobody wants to assume a 5.1% loan, in 2021, but because they were facing a $2 million prepayment penalty, we were able to knock that price down significantly. But
that's right.
Yeah, lot there. So anyway, we're about out of time, guys. Thank you so much for coming on the show today. One question for each of you to end things. How can listeners learn more about you? Mark, you go first.
Sure. Yeah, they can just visit our website, thinkmultifamily.com, or you can email me at mark, M-A-R-K, at thinkmultifamily.com. Love to hear from your listeners.
Perfect. And Marquis, same question for you.
Yeah, likewise. I'm active on LinkedIn. You can just type my name in, Marquis Campbell. If you would like to email me, it's 1111llc92@gmail.com.
Yep.
I'll be more than happy to answer any questions and collaborate.
Yep. So anybody listening, if you want to contact them, you want to learn more about them, head down to the show notes and tap, and that magical internet thing will whisk you away. So once again, thank you so much for coming on the show today, guys. I think this is a great little episode, and I enjoyed it a ton.